All right, today we're going to put on our economist hats and dive into a really interesting puzzle at the heart of the Indian economy. On one hand, we hear it's one of the fastest growing economies in the world, but on the other, its currency, the rupee, always seems to be under pressure. So we're going to dig into the numbers and see what story they really tell.
So, let's start with the official story. We've heard it stated right in Parliament. The rupee is doing fine. This is the official narrative, the baseline of economic stability. But, our job here isn't just to take statements at face value. It's to test them against the hard evidence.
And that really brings us to the central mystery of this whole thing. If the economic fundamentals are so solid, why does the rupee always seem to need defending? There's a big disconnect between that story of strength and the reality of market pressure. And that's the puzzle we're here to solve today.
Okay, let's start our investigation with suspect number 1, India's trade in goods. This is, the most basic level of how the country interacts with the world's economy, and right away it shows a pretty significant problem.
Just take a look at the numbers from the last fiscal year. They paint a really clear picture. India brought in, or imported, $721 billion worth of goods, but only sold or exported $437 billion. Now, that is not a small gap. That's a massive trade deficit, and it means a ton of dollars are flowing out of the economy.
And if you're thinking, well, maybe this was just a one-off bad year, think again. This has been a trend for a while now. The deficit has been getting wider and wider, going from $184 billion back in 2018 to a projected $283.5 billion. When you see a trend like this, it points to a deep, structural issue in our trade.
So, who exactly are we trading with that's causing this deficit? Well, a huge chunk of it, over $85 billion, is with China, mostly for manufactured goods. Then there's Russia, with a nearly $57 billion deficit, mostly driven by oil and energy. On the flip side, our biggest trade surplus is with the United States, but that in itself is a risk. If anything were to disrupt that one relationship, our whole trade picture would get a lot worse.
Okay, so if we're hemorrhaging all these dollars from the goods trade, a huge question comes up. What's stopping a full-blown currency crisis? What's keeping the rupee from just collapsing? Well, the answer lies in two really powerful forces that we can call the economy's silent stabilizers.
The first stabilizer is this massive inflow of money, $130 billion in what we call remittances. Now, it's so important to understand this isn't money being generated by factories or companies inside India. No, this is the hard-earned money of Indians working abroad, in the Gulf, in the US, in Europe, sending money back home to their families. It's a vital, steady stream of dollars that helps plug the hole from the trade deficit.
The second stabilizer is even bigger. It's India's world-class services sector. Our IT companies, our outsourcing firms, our consultants, they are absolute powerhouses on the global stage, and they bring in a net surplus of almost $189 billion a year. This is India's #1 dollar-earning engine, and it is absolutely critical for keeping things balanced.
So let's just step back and picture this. On one side, you have our manufacturing sector, which is actually a net drain on our dollar reserves. But on the other side, that gap is being filled by the brainpower of our service professionals and the hard work of Indians living overseas. It's really a tale of two completely different economies.
But remittances and services aren't the only way dollars come in. Historically, there's been a third pillar of support, foreign investment. But recent data shows this pillar is starting to show some pretty serious cracks. Let's take a look at something called foreign direct investment, or FDI.
This table is really revealing. Look, the amount of money coming into India, that's been kind of flat. But what you really need to watch is the outflows, the investment capital that is leaving India. That number has skyrocketed from just $11 billion to $57 billion in only a few years. And what that means is that the net FDI, the amount that actually stays in the country, has completely collapsed from over $57 billion down to just $23 billion. That is a huge red flag.
Okay, so we've got a lot of moving parts here, right? A huge deficit from goods trade, strong surpluses from services and our diaspora, and weakening foreign investment. So how do we add all this up to get the final score? Well, for that, economists use a special measure called the current account.
The easiest way to think about the current account is to just imagine it's a household's monthly budget. It's all the money a country earns from the rest of the world, from exports and remittances, minus all the money it spends abroad, mostly on imports. If the number is positive, that's a surplus. You earned more than you spent. If it's negative, That's a deficit. You spent more than you earned. Simple as that. And here is India's final report card. If you ignore that one weird year during the COVID shutdown when everything was topsy-turvy, you can see that the country consistently runs a current account deficit. Now, it's gotten a bit smaller recently, down from that high of 67 billion, but the basic fact hasn't changed. Even with all the help from services and remittances, India as a nation still spends more dollars than it earns.
And this leads us to the final, and maybe the most critical piece of the puzzle. If the country has a net deficit, meaning more dollars are flowing out than are flowing in, basic economics tells you the rupee should be getting weaker. So how on earth is it being described as stable?
Well, the simple answer is that the stability we're seeing isn't a natural result of the market. It doesn't reflect the fundamental economic picture we've just spent the last few minutes painting. No, it's actually the result of direct, deliberate intervention.
And right here, this is the proof. This is the smoking gun. India's foreign exchange reserves, which is basically the nation's savings account full of foreign currency, have dropped by about $30 billion. A central bank does not dip into its savings unless it has to pay for a shortfall, and in this case, it's selling dollars to prop up the value of the rupee.
The way this works is actually pretty straightforward. When there's a lot of pressure pushing the rupee down, the Reserve Bank of India steps into the market. It literally sells US dollars from its savings account. This floods the market with more dollars, meets all that excess demand, and poof, the rupee's exchange rate stabilizes.
So the next time you hear that the rupee is doing fine, you'll know the whole story. You'll remember the three pillars holding it up: the money sent home from Indians abroad, the incredible power of our services sector, and, crucially, the direct intervention of the central bank using its savings. This isn't a story about fundamental economic strength. It's a story about carefully managed support, a support system that is being stretched thinner and thinner.
What all this data shows us is a managed stability, not an organic one. The imbalances underneath are real, and the systems holding everything up are not infinite. And that leaves us with one final, unavoidable question. How long can this delicate balancing act really last before the sheer weight of the numbers forces a painful change?